Hello, everyone. Today on the Final Bar, we will kick off this week talking about Monday's movements, gapping higher out of the open, finishing really toward the lows of the day. Quite a reversal during the day. Some negative news from Apple really driving things to the downside. Energy, the big winner today. We're going to talk about these overall trends. We've had a lot of choppiness. At the end of the day, it's all about looking at the current day's movements, but then taking a step back, looking at the big picture. What are the overall trends? What should we expect in the coming weeks? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. It's Monday, July 18th. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Hope you had a great weekend. Thanks for joining us on Monday's show here as we break down the activity in these markets using the power of the technical analysis toolkit. I was taught that price has a lot of information. Books by John Murphy and Martin Pring early in my career taught me how to think about price action because it reflects the interplay of fear and greed. Fear driving prices lower, greed driving prices higher. We're so fortunate at StockCharts to have people like John and Martin writing us regular commentaries so we can see how they are tracking these markets using the concepts that they've written about for decades. We also have a lot of fantastic tools to help you apply it to these markets. We're going to try to put the power of StockCharts to work the best we can here in our 30 minutes together. Make sense of these markets. Today, earlier in the day, felt like a bit of an accumulation day, sort of a nice rally after some short-term strength coming out into the last weekend, changing gears in a big way. We'll talk about that short-term intraday reversal, some distributive candle patterns, which we'll highlight as well on a number of individual names and ETFs. We have great guests on the show. I'm excited to have some of the conversations this coming week. We have two great guests for you. Jay Soloff from Investors Alley is coming through. We also have Todd Sohn from Strategas. Coming up later in the week, Thursday and Friday, we have some special programming for you. On Thursday, we're going to talk all about trendline analysis. In a market like this, where the average stock is going lower, it's all about using a trend line off of the previous highs as a way to determine when things are starting to recover. That was a great way of analyzing the Chinese ETFs, by the way. We'll show some examples there and what to do with them. Also, the value of learning from market history. That's going to be next Friday. Really, really well done. It highlights some of the historical charting capabilities of the StockCharts platform. This is a really good time to be going back to previous bear market phases, try to make sense of these markets. Let's continue on today's show. The market recap is where we break down today's movements and connect one day's movements to the bigger picture. And let's get to the charts. The S&P 500 down 0.8% today, and that was quite a change. Earlier in the day, we traded right up to 3,900. The market was repelled at that level, tried to retest it here right around lunchtime, failed. Then all of a sudden, we quickly accelerated to the downside, finishing more toward the lows of the day. Bounced a bit in the last couple minutes, but overall, a weaker day, down 0.8% to 3830. Mid caps and small caps both outperforming, essentially flat for the day when all was said and done. Volatility increasing. Today was the definition of volatility, I feel like, and the VIX bouncing back up a bit, currently around 25.4. Interest rates broadly moving higher, although they came off through the course of the day, but still finishing up a little bit. The 10-year yield is still below 3%. It tipped just above it earlier in the day, but finished just below it. So really that 3% level was an important one. Many of us followed for quite some time because that was quite a change from obviously the weaker rate environment we had been dealing with for so long. We're in a rising rate environment, I would argue, even though there's been some choppiness. Watch that 3% level. The dollar index coming off and the strength in the US dollar has been one of the key stories in 2022. That's why charts like gold and others have been absolutely struggling because a strong dollar, it's called sort of the wrecking ball of the markets, and it's followed through on that for much of 2022. Not the case today, though. It's down about 0.5%. Gold and silver actually flat for the day. Gold had it was a crazy shape day from a technical perspective. A lot of things like gold, even the S&P, gapped higher in the open, but then closed back lower. Gold sort of basically coming back to the unchanged level, which is where it was at. A lot of green on the page of cryptos here. We follow about 100 and, I don't even remember, 160, 170 coins, I think, at this point. And if there are more that we don't have on that you'd like to chart on our platform, just hit our support desk. We're happy to add whatever you guys need to analyze these charts of interest. We track here the 10 most liquid coins, the 10 most commonly used coins on our platform. Bitcoin currently up around 3.5%. Ether much better, up about 9%. If you look at the chart of Bitcoin, though, you can see how it's really performing essentially as a risk asset. See the similar rally at the equity open, but then deteriorating through the course of the day, sort of in a downward direction. Again, higher through the course of the weekend, and bouncing off of sort of the upper teen thousands, if that's a word, and now in the lower 20s, around 21,530 right now. Let's look at a chart of the S&P 500 and just see how today's movement fits into the big picture. It almost felt, as we were selling off into the close, that we might get a bearish engulfing pattern. Now, we did get that for some things. I think, for example, the high yield ETF, I'm kind of jumping around. Sorry for that. Yeah, the high yield ETF is HYG. This is what I was looking at as I was prepping for the show. This is a bearish engulfing pattern, right? Where you have a rally, you have a big up candle, and then a down candle, the second day's candle, the body of the candle, which is the open to close, engulfs the open to close range of day one. So wider range in an uptrend, an up day on day one, a down day on day two. Look at how this happened right at the 50-day moving average. It's a pretty distributive pattern. That basically tells you that there was accumulation on Friday that turned into distribution. Short-term optimism turns on a dime, and all of a sudden is fairly distributive. Essentially, investors bid high-yield bonds up to the 50-day moving average, and now telling you, nope, it doesn't have the staying power. It's going to come off. So that's a short-term bearish sign for high-yield bonds. Usually maps pretty well to the S&P because it's sort of a different way of playing on more risky companies, more speculative companies. Not a great way to start the week, to be honest with you, if you're bullish, because it's sort of indicating some inherent weakness. Now, this is as we are setting up for a lot of earnings, and we'll try to hit some of those charts here in a few moments to sort of prepare for this coming week. Back to the chart of the S&P, we've been talking about what I would just loosely describe as a coil pattern. It's not a textbook coil pattern, which would be a clear pattern of lower highs and higher lows. This one's a little messier, so it's not an ideal pattern, but certainly tells the story of consolidation, right? You have the accumulation phase in the second half of 2021, and even before that, the distribution phase that I would argue we're still in. But if you look at the last 6 weeks, it's essentially been sideways, even going back to mid-May. We bounce off 3,800, really 3,810 there. We rally up a bit, and then we come down. And from here, this is still sort of that second bounce. Imagine that you have a basketball, you drop it, and then it bounces, 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 bounces. Every time it bounces, it's a little bit bounces a little bit lower. And so that's kind of what this market has done. It's settling into a fair value. This is basically saying investors are pretty much pricing the S&P at around 3,800, 3,850. And so which way are we going to go next? And I think either one of these two things will happen. Either we accelerate to the upside, we get above 3,950, sort of exiting this pattern to the upside. That would have to be driven by a lot of individual names showing a lot more strength. And the news from Apple today, where you see Apple selling off, we'll get to that chart next, is not the way that that's going to happen, right? You need more positive news on earnings. You have a lot of a bunch of different things reporting this week: some healthcare, some materials, some industrials, communication services, or a number of sectors that are reflected today. Banks earlier in the day today, IBM after the close. Those names are going to have to surprise to the upside to give the S&P enough upside momentum, right? It's going to have to be driven by those stocks. On the other hand, let's say things continue to distribute through the course of the week. This is setting up for the Fed meeting next week. All of a sudden we go lower. We start getting below 3,700, 3,650. This is exiting that pattern to the downside. So when you have a period of lower volatility, which is what we're seeing now, it's all about the wait and see until we get the movement. What's the direction of momentum after this? Do we exit this consolidation pattern to the upside or the downside? I think that's the main question investors should be asking. Now, if you ask me, which way are we more likely to exit? I would have to say downwards. And the reason is because any trend following mechanism that I would use right now is still overwhelmingly negative, right? The sentiment has been fairly beaten down for quite some time. One of my guests last week, Sam Burns, if I remember right, on Wednesday's show, if you go back to that one on StockChartsTV.com, we talked about sentiment, bearish sentiment really at extreme levels right now, which is true. Kicker is the market can continue to go lower, even in those extreme sentiment environments, and that most likely I would think is what we're seeing right now. But given the fact that my market trend model is negative on all time frames, that tells me to assume that the path of least resistance is lower until proven otherwise. And that's what I would be looking for at this market. Just to finish off our market recap and quickly segue into our next segment, when we talk about sectors, it was energy and basically then everything else, and utilities, healthcare, real estate, some of the defensive sectors at the bottom of the list. Energy an outlier a bit to the upside. Let's get to our next segment called sector setup. So we talked about the big picture, talk about some short-term weakness in stocks and really how that mirrors, I guess, lines up with the longer-term weakness that we've been in, right? 2022, obviously a pretty painful year, but one of the key themes in 2022 has been the strength in energy versus everything else, right? And if you look at the overall returns of these sectors over time, you'll see that energy really dominates. This is the RRG. This is the relative rotation graph. I like to start here when we're talking sectors. Julius de Kempener designed this visualization a while ago, and it's so beautifully done. It shows how the 11 S&P sectors rotate around the S&P, which is at the crosshairs there. To the right means it's outperforming. To the left means it's underperforming using the type of data you select up here at the top. And the vertical axis gives us the momentum, right? Is the momentum increasing positive momentum, increasing negative momentum? By the way, as a quick preview for you, if you do use the RRG, which I do every single day, you will notice here in the next week or two, you have some additional options because we have intraday RRG coming very, very, very shortly. We're just finishing the quality assurance portion, the final step to make sure we're ready to release it. But part of our Bainbridge software release coming up here shortly, you have the ability to do hourly, 15-minute, even 5-minute RRGs and really watch how these sectors are rotating during the trading day. We are looking at a much longer term perspective here right now, looking at weekly data. So this is looking back over at the last 6 weeks and really drawing in 4 weeks, drawing in a lot more data because this is based on relative strength trends that evolve over months and months to generate these data points. You can see that energy has been by far the strongest, and it's been the outlier the entire year by any measure, but certainly on the RRG. But look at the direction that it's heading. It's heading southwest, which is what I would call the direction of deterioration, right? Improvement would be heading northeast. That's where the trends, the momentums are starting to improve. You see that in technology and communication services. You're seeing the opposite rotation. You're seeing still outperforming over time, but the momentum is really going the wrong way. And that's the way I would describe energy, utilities, consumer staples, materials, even industrials. These are the areas of the market that had been stronger on a relative basis, but really starting to deteriorate. The optimistic version, or what you would be looking for if you're optimistic on energy and you're looking for some validation that energy is starting to work again, you need these to rotate back to the northeasterly direction, back into the leading quadrant while it's over on the right side of the y-axis. That's a strong trend where the cycle is just evolving a little bit. What most likely is going to happen, though, is these rotate down to the lagging quadrant as other sectors start to improve. Now, this is a zero-sum game because I'm looking at the 11 S&P sectors versus the S&P. So all of these net out to a zero, and you know how much market cap is in these sectors. Consumer discretionary, technology, communication services. These are the FANG sectors. Those three sectors literally outweigh or an equal weight to all these other ones that have had such strong performance year to date in 2022 on a relative basis compared to some of those growth sectors. On the shorter term, you can pay attention to some of the other sort of shorter term swings in these sectors. And the way I like to do that is by going to the candle glance function. So the candle glance is where we take a bunch of charts, we throw them up on the screen at once. We can now visually compare where they're at. The RRG for me is a great top level, what's leading, what's not, what's working, what isn't, and get a sense of where the strengths and weaknesses are. The candle glance function, which we're using now, is a way to look at a series of charts, whether it's sector ETFs, other ETFs, individual stocks, or even industries, and you can start to compare the patterns and see what looks similar and what looks different. This is where outliers start to jump out at you. For example, out of these 11 S&P sectors, how many of them are above their 200-day moving average right now? How many of them are above their 200-day? The answer is not many because consumer staples has remained below the 200-day. Energy has jumped higher off of the 200-day moving average just today. And the only other one, and it's just barely there, is utilities, which is here, literally closing right at the 200-day moving average right now. So overall, out of the 11 S&P sectors, really only one that's actually remaining above its 200-day moving average. So let's focus here for a moment on energy. If we take the low from March 2020, which is off the viewable area to the left, we then take that trend to June of 2022, which is to this point the high for the year for the energy sector. What have we done? Well, we've retraced almost exactly 38.2% of that way from March 2020 to June 2022, which is where energy has topped out so far. We've retraced 38.2% of the way. So that $65 level for the XLE is a key area of potential support. Lines up pretty well with the support we had in the first quarter here at the end of February. So we've now come back to those same levels. We're also bouncing off of the 200-day moving average. So we have here what's called a confluence of support. My conversation, by the way, last week, who was I talking with? I forget. On Thursday, my guest on Thursday, Carolyn Barodin, it would come to me. Carolyn was talking about confluence zones, right? Where you have different Fibonacci levels or other support and resistance techniques where they all agree at a certain price level. It's kind of what we're doing here, right? The 38.2% Fibonacci level lines up with the 200-day moving average. Totally reasonable to expect a bounce there, which is what we've gotten here over the last, really couple of weeks for the XLE. That's encouraging in the short term. It can be pretty negative for the long term, though, if we fail to hold 65. And as this week progresses, as we start to get earnings from a number of different parts of the market, a lot of different sectors, as I mentioned, a representative will look after the break at some of those individual stocks reporting earnings this week. But I think the 65 level on the XLE may be one of those key levels to pay attention to see if we're able to hold there or not. Looking back at the 11 S&P sectors here, just to finish off our segments, we want to look at these. Where else do we want to go? The growth-oriented sectors. So the three really kind of primary FANG growth types of sectors are communication services, consumer discretionary, and technology. How much do we like these charts? I would argue not a lot just yet. Here's the chart of the XLY. This is the consumer discretionary chart. What's encouraging is that it's not going down anymore, right? You made a new low in June. So far, we have not made a new low in July. We've actually made a series of higher lows. That's encouraging. But have we really broken this trend and reverted to the upside? It felt like it might be starting. When I was looking at this chart earlier in the day, I saw this gap higher, this move higher, and I'm thinking, oh man, we're getting out of here, breaking above the 50-day and rotating out. We closed right back below the 50-day moving average just today. So this week, I think ending up being a relatively pivotal week to see if we're able to mount any further strength from what we've seen so far. Let's take a quick commercial break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. It's great to be back with you here on Monday, making sense of these markets the best we can. This is an exciting year. As in the 2022 has been fascinating. Bear markets are so great in terms of opportunities to learn. And that's one of the great things about financial analysis and technical analysis, the ability to learn from market history and incorporate new data every trading day. Let's continue to learn these lessons together. Before we get to our next segment, Shifting Stocks, a couple quick housekeeping announcements for you. First off, we welcome your questions. We're going to do a mailbag segment on tomorrow's show on Tuesday of this week. We'd love to answer one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. We're on YouTube as well. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. There's so much great content every trading day, educational content to help you better understand the markets, market history, market dynamics, informational episodes talking about what is happening as our suite of experts follow these markets, and some great analysis and perspective to help you think about how you might want to be positioned and how you might want to manage risk as well. Go to StockChartsTV for all .com for all that great content, or on your mobile device, just search for StockCharts TV on demand. Our next segment today on a Monday show is to finish this three-pronged approach to market analysis. We talked big picture, we talked sectors, and now let's talk individual names in our segment called Shifting Stocks. Now, we had a couple stocks that were reporting before the open today and after the close. I just want to highlight here very quickly. So interesting when you look at some of the banks, right? So if you look at Bank of America, a lower move on Thursday of last week, Bank of America got down to $30 a share, moving higher on Friday. And this is sort of a nice recovery day for a lot of those financial stocks. on Friday. We had a bunch of them that reported on Friday after the close. Things like let's see, Wells Fargo, Citi, PGR, Progressive, BlackRock, PNC, BNY, all of those were on Friday. We continue a bit of them today with Bank of America, Goldman Sachs. We'll look at here in a moment. So again, this day looked very different early in the morning as I'm reviewing some of these companies just reporting and looking at what the stocks are doing. It's a nice open and a move higher. Bank of America got above 33, nearing the 50-day moving average. It started to feel like you might get this follow through to the upside. All of a sudden, this great recovery day. It ended up fizzling pretty hard. And so at the end of the day, Bank of America essentially finishing where it was on Friday. So that is a concern, I would argue, in terms of earnings season, right? When things are good, when the market's in a bull market phase, I'm going to zoom in just a little bit. This candle focus chart that I have is a great way to just sort of zoom into the short-term trading. You have this doji candle on Thursday of last week when it hits 30. You jump on Friday with this nice up day, making a new swing high in the short term, which is encouraging. Here's what happened today, though. You gap higher on positive earnings. You trade lower and we're basically unchanged for the day. That's bad news, really, when a company outperforms expectations, gaps higher, indicating that people are optimistic given that. But the overall macro environment is keeping the optimism very muted, right? The fact that Bank of America is saying some good things in their earnings report, and I did not look at the details of it yet to speak with any intelligent knowledge of the details of it. I'm just thinking from a technical perspective, when things gap higher on earnings, that means something good came out of it. But when it doesn't follow through to the upside, we don't have that upside follow through, indicating that additional buyers are coming in. That's not the way that a bull market progresses. That's a way that a bull market is tempered. And all of a sudden you get more of a bear market phase because the optimism that you need to drive asset prices higher is not really materializing. Goldman Sachs a little bit better in terms of a bigger gap to the upside, getting above the 50-day moving average, but closing back below it. So just like in late June, you had a move to the 50-day moving average that was repelled. We may be seeing that same sort of thing as we distribute a bit after gapping higher at the earnings this week. Again, very important when you're talking about earnings and the charts to wait for the next day to see what sort of follow through you have. The day of earnings, the day before the day of earnings, always pretty noisy because there's a lot of competing things that are happening, a lot of different investors with different motivations and it's usually a short-term reaction to what people read and heard. The longer term, right? What happens after that is when investors actually have had a chance to digest what they heard from Goldman and Bank of America and others. And then we actually start to see what happens afterwards. Taking a step back on Goldman again, I mean, nice gap higher, that's encouraging, but within this context of the trend, this certainly looks like we're failing at 310, which is the resistance level we had back in June. So a nice jump higher, but really failing to get to a new swing high. You'd need to see something like GS above 310 to indicate any sort of upside follow through. So now you have 310 on the upper end, 280, 275 on the lower end. And I think that's an important chart to watch as well to see which side you get follow through. The chart of Goldman might be a great overlay to the chart of the S&P itself to see which side has control, buyers or sellers. IBM after the close today, I haven't looked at the numbers right now, but we can take a look very quickly how it's doing in the after hours. By the way, if you ever want to look at after hours trading on StockCharts, you bring up the chart. And then below the chart, there's a little button that says symbol summary. That'll get to this page. Also at the top of our website where it always says sharp chart by default, you can change to symbol summary, type in the ticker, and it'll give you this page. This is great descriptive information, a summary of financial data, valuation ratios, earnings, technical data as well. Also information about what the company does, where they're located, all that kind of good stuff. But at the top, you can see whether they report earnings today, tomorrow, or if they just reported, and you can see the after hours trading here. So it closed down about 1.25% in the after hours, currently down 2.4%. Now the after hours a little less liquid, very, very noisy. So I would wait to see how that plays out through the course of the after hours session, and obviously look at it in the morning. But if you look at the chart of IBM compared to technology, this has been one of the best performers. I mean, talk about an outlier in large cap tech. This is one of the larger names we would be looking at in the technology space. While many of them have been underperforming chronically in 2022, IBM actually has put in a pretty decent run from last November. While the S&P topped out in January, the NASDAQ topped out in November. That's actually the low for the last 8 months for IBM. It's actually had a nice rotation higher. Now it's struggling to sort of follow through here, pulling back to the 50-day moving average, which might be important. If I had to own something in technology, this is the type of chart I would probably want to own because it's an outside outlier, right? It looks very different than the rest of the technology sector in a very good way. But it's worth noting the RSI is kind of neutral. It's right at 50. IBM's no longer making new highs. It's sort of pulling back a little bit. And we'll see how things play out through the remainder of this week after earnings today. Elsewhere, we have a lot of other companies reporting earnings this week, and I'd encourage you to take some time to look through the charts leading up to there. Netflix is the next FANG name that we have reporting. That's actually tomorrow after the close, if I remember right. So it's so funny. The chart of Goldman Sachs, we talked about this framework, right? Clear resistance, clear support just in the last couple months. The same thing is the case for Netflix and a lot of the other FANG stocks as well. Netflix made a new 52-week low in May and has not undercut that on an intraday basis in June or yet in July. Now we have a clear frame of reference, right? 200 on the upper end, 170, 165, we'll call it on the lower end. There's your range. It's almost a rectangle pattern, right? Sort of a sideways trend. One of these things will happen here, most likely in the next week or two. We either break above 200 to the upside, we break below 165, 160, we'll call it, on the lower end. I would argue whichever way the charts of Netflix and Goldman and all these other ones break, that's the trend in the market. Again, my concern is that these things break down. And if they do, what does that do to the S&P, to the NASDAQ, who have been, holding support levels recently? Names like this break down, and that could certainly be a concern. Finally, other ones, just very quickly, we have Tesla reporting on Wednesday and a number of others on Thursday and Friday as well. Probably later this week, we'll do a segment particularly on earnings where we'll dig into some of these that have reported and just update on how these charts have changed around their earnings releases. We need to wrap the show, folks. 30 minutes goes by so quickly, but it's fun to share these charts with you. Let's go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number one. When we look at the chart of Apple, I think this is a key story. Big story today was Apple with news basically talking about their hiring plans and growth plans, and a bit of a cautionary warning from the company. Apple finishing the day down 2%. I don't think that's the real story, though. Take a step back from this chart and look at how things have evolved. Go from March 2020, the low for the last couple of years, to January 2022, the peak in Apple so far for the year. Look at how we have now retraced 38.2% of the way. That's come up on a number of charts we've talked about so far, which means that's encouraging. As long as 130 to 135 holds, this is a pretty good retracement. It's about a third of the way, just over that from the last couple of years. But what happens if that breaks? That's why this level, if we do sell off from here, I'd be watching there. We've sold off from 150, which is this blue shaded area. Look how many times that 150 to 155 level has been so important. It's been a key level to watch on Apple. We've pulled back now from that level, and the RSI has stalled right at 60, which is classic bear market behavior. Chart number 2 is the high yield ETF, ticker HYG. There's another one that a lot of people refer to, ticker JNK. They're pretty similar, some differences in the structure of these, but it depends on, I think it's iShares, and the other one's the Spider, the S&P Spider one. We'll be looking at bearish engulfing pattern today for high yield debt at it as it hits its 50-day moving average. That is not a good sign for high yield bonds, and I would argue also not a good sign for other risk assets like equities. Finally, year-to-date returns on 10 different ETFs. These are basically the Morningstar style boxes. Look at value ETFs down about 11 to 14%. Growth ETFs down about 23 to 26%. Middle of this, which is basically the core ETFs, all about the same. Large cap, mid cap, small caps, identical returns in for all intents and purposes, down 18.5 to 19% for the year. Folks, that is a wrap for our show. Thanks so much for joining us on a Monday afternoon as we break down these charts together. All of our previous episodes and some amazing interviews are at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.